Hello everyone, welcome to Risk Management 104, my specialist subject, financial market behaviour. I'm Darren and today we discuss market psychology and mastering your emotions. What's the biggest challenge in trading and investing, and who's your worst enemy? Well, I'm sure you know the answer, it's yourself. I'll break down common psychological pitfalls today that sabotage all strategies and some tricks to overcome them. Remember, trading isn't just about charts and numbers, it's mostly about mastering your emotions. Are you kept awake at night worrying about your financial positions? Are you distant with friends and family because you are addicted to watching charts, trying to catch every trade? Overtrading is a classic and addictive trap. You think more trades means more profit and faster learning, but that is a myth. In reality, overtrading stems from boredom, impatience, or excitement. In other words, emotions. You end up forcing entries that don't align with your system, racking up commissions and losses, but more importantly, exhausting your brain, leading to more mistakes in the future. The same issue arises with watching the charts too much. What's the point of watching every minor candle movement if you have already set your parameters? Not only is it a waste of time, but it wipes out your brain. Do you really need to open the charts every minute to see what's happening? No, you don't. The fix for this? You need to be fresh to avoid mistakes. Rest is important. Time away from the charts is important. Stick to your rules and wait for positions to come to you. Don't go chasing candles. Quality over quantity. And the sooner you learn this, the more profitable you will become, almost immediately. Treat your trading and investing like a business. Set operating times, say 9 till 5, and avoid working after that or looking at the charts. Set limit orders and trailing stops to automate positions while you're away. Set daily and weekly risk limits based on your strategy. And remember, no position is a position. Sitting on your hands is most often the best move to make. All of the great investors have many quotes on this matter. And remember this tip: the lower the time frame you choose to analyze, the less accurate you will be, leading to frustration, thus mistakes. Start on the larger time frames, weekly and daily to begin with. Swing trading. Now, let's talk about ego. Ego is the account killer and the reason for most of these problems. When emotions run high, people ignore their risk management, position sizing entries, take profits and stop loss levels, and start betting big, attempting to chase bigger wins or avoid losses. But markets are unforgiving and don't play favourites. Behaving like this makes you a gambler, not a market speculator. Picture this: you take a loss, you were sure you were right. Anger or frustration boils up inside. You think, I must make my losses back right now. So you dive into another position impulsively, often with even bigger position size, only to rack up even more losses. This is revenge trading. This vicious cycle is fueled by ego and raw emotions, not logic. To break the cycle, you must step away after a loss, take a walk, journal your trades to vent, and only re-enter when you're calm and the setup is rock solid. If you have followed your rules in a robust system you trust, you should never be angry anyway. Fear of loss is another killer. You might slide your stop loss further away or abandon it entirely just to avoid getting stopped out, hoping the trade turns around like some fairy tale. But what happens? The loss balloons huge and you end up losing way more than planned. This is pure avoidance. Ego hates realizing a loss, but cutting it early is the key to survival. On the flip side, greed sneaks in when things are going well. Ever moved your original take profit higher to get more gains, only for price to turn around and wipe you out? Or you yank take profit too early because you're terrified of giving back the gains, only for the position to keep blasting off and you would have won big? Or how do you control this? Backtesting and building a robust system you trust and matches your risk profile is essential. In other words, a plan is essential. Understand your strategy, honour your original stops and targets. Let winners run, trail stops wisely, Don't mess with targets emotionally. Can't handle losing? Then you've allocated too much capital to your portfolio that you're not actually comfortable with risking. Your emotions will scream this at you, and you'll know it's time to reduce your allocation and start somewhere you're truly comfortable with, especially while you're learning. Don't ignore those warning signs. Always define your risk per trade up front. Stick to 1% of your portfolio at first and enforce those rules rigorously. No exceptions, no shortcuts, because one blown up trade can wipe out months of hard work in a heartbeat. Have you ever been so afraid of entering trades because of a string of losses that it keeps you out of the market? That fear makes you freeze up and miss out big time, or worse, you chase price higher. Fear sets in hard. You stop entering trades altogether because you no longer trust your system. Suddenly, you find any excuse not to enter a position. To combat this, again, backtest your strategy thoroughly and regularly. You must trust your system. Understand the law of large numbers. That is to say, over many trades, probability will play out in your favour, but short-term results are totally random. Losses are part of the game. They're not a sign your system is broken, they are part of the system, an essential part, the pay-to-play part. Stick to them and the edge will shine over time. Conversely, a string of wins or lucky streaks breeds overconfidence. You feel invincible, start overtrading like crazy, ignore risk management, ditch your strategy completely. You reason with yourself, if I keep this up, I can pay off my house. Just a few more wins like this and I'll be a millionaire by the end of the year. I am a master investor. Markets will humble this attitude fast and hard. Markets take the stairs up and escalators down. It is important to stay grounded, treat every position independently, and never let short-term success pump up your ego. Ego causes people to do stupid things like post screenshots of unrealized profits on social media or their portfolio value, only to watch these evaporate behind the scenes. It also causes them to refuse to take a loss, stubbornly holding on to positions and rebranding themselves as a long-term investor just to avoid admitting defeat. When the markets are bullish, do you feel underexposed and FOMO into bad positions? Or when they are crashing down, do you feel overexposed as losses mount up? Greed and fear are in control here, and it also results in poor risk management. Capitulation fear is huge in investing. Prices plummet, bad news follows, and you sell everything in a panic, only for the bottom to form right after and the asset to go to new highs. Or you buy at the top chasing hype only for price to free fall immediately. This is poor risk management at its core and a disaster for your mental health. The antidote: detach from the chaos, turn off the headlines and noise, focus on your system, stick to your plans, have conviction in your analysis and long-term outlooks. Paralysis by analysis is another psychological hurdle. Do you overload yourself with too many indicators, systems, multi-time frame analysis, which just leaves you confused and frozen? Trading multiple time frames is tough. Stick to one that suits your style. Pick a few reliable tools and master them. More is not better. Trust in yourself is everything. One of the biggest account killers is closing positions too early out of fear of a reversal, but the big wins come from letting those runners run free. This requires understanding the macro environment, solid target analysis, and using tools to spot potential extensions. Cut losses quick and ruthless, but give winners room to breathe. That's where the big profits are, along with compounding small wins. Even when you win, psychology can still undermine you. You might feel like your gains aren't enough, always chasing more and more. Set a realistic benchmark, like beating the market by 5 to 10% annually. Celebrate when you hit it. Contentment prevents greed from turning your wins back into losses. And finally, do not compare yourselves to others. Comparing yourself to others is poison and should be avoided at all costs. Everyone has individualized risk profiles that are unique and should be treated so. Beware of platform reporting methods like on eToro. Many users skew their data to cherry pick gains, ignoring massive drawdowns from previous years. claiming hundreds of % returns when they're really just back at break even or worse. Some platforms reporting are designed this way to lure in the unsuspecting. Don't fall for it. Focus on your own path and never stop learning. Every loss is a lesson. Okay, guys, I hope this session gave you some insight into how the market makes you feel and how to manage yourself. Hit the subscribe button for my upcoming technical lessons and leave a comment on your hardest psychological struggle. And check out the link to the High Volume Notes series below. Thanks and safe trading.